everyone, and welcome to today's webinar. On behalf of YouGov, I'd like to thank you all for attending. My name is Rachel Zaminsky and I work in the sector marketing team, and I'm going to be moderating the audience Q&A at the latter end of the webinar. We're here today to discuss how brands can navigate the ever-evolving financial services landscape and consumer attitudes towards sustainable finance. Before we go any further, just a little bit of housekeeping. If you have any questions at any point in the presentation, please write and submit them via the chat function. We have dedicated time at the end of the session to come back to these, and we'll try and get through as many as possible. We are recording today's webinar, and we'll share that alongside a copy of the slide deck to the email that you registered with afterwards. Right, without further ado, let me introduce today's speaker for the webinar. The speaker joining me for this webinar is Emma, YouGov's Global Sector Head of Financial Services, as well as Irvin Ha, YouGov's Head of Commercial for APAC. I'll now pass over to Emma to present today's webinar.
Thank you very much, Rachel. Good morning, good afternoon, or even good evening, depending on where in the world you are joining us from today. Firstly, thank you all so much for taking the time out of your schedules to join us for this webinar. As Rachel has mentioned, the session will last just over 30 minutes in total, and we'll leave 15 minutes at the close to answer any questions you may have. Feel free to submit those questions at any time during today's session via the Q&A button, and we'll endeavour to answer these at the end of the presentation. Before we begin, let's start with a quick introduction to the speakers. My name is Emma McInnes. I'm the Global Head of Financial Services here at YouGov. I have over 20 years of experience of working in financial services research, with much of that time spent working on an international scale with some of the world's biggest financial brands. My specialisms are in brand and marketing effectiveness, and I have a huge passion for the topic of sustainability in financial services. I will be walking you through the research data that we have used for the presentation today, and I'm joined by Irvin Ha. Irvin, would you like to do a quick introduction to yourself?
Sure, definitely. Thank you very much, Emma. Hi, everyone. My name is Irvin. I am the head of commercial for Asia Pacific, and this means that I lead a team in Asia to bring our world-class syndicated and ad hoc solutions to our clients. Our clients have been leveraging our data very, very strongly to create a lot of great strategies that help them grow their business.
Wonderful. Thank you very much, Irvin. So without further ado, let's get started with a short summary of the three key prevailing trends that are affecting the financial industry as a whole, and which we'll explore in more detail during today's session. Firstly, industry fragmentation. The rate of digitalization has had a profound impact on the financial services industry, with consumer expectations and behaviours fundamentally changing the way in which they want to interact. This trend has been accelerated by the COVID-19 pandemic, with consumers increasingly shifting towards digital services and channels and accelerating adoption rates. Alongside this, digitalization has fundamentally reduced the cost of entry to the industry. We've seen the rise of digital-only brands challenging traditional banking spaces, the emergence of new business models and innovations that challenge the status quo, like buy now, pay later, and the creation of financial products like cryptocurrency, once seen as having niche and short-lived appeal, increasingly becoming more mainstream. Consequently, the industry, once seen as one of the slowest to innovate, is now experiencing an unprecedented rate of change. This leads us on to the second key trend we're seeing in the industry, which is that a dichotomy now exists between trust and innovation. Currently, trust remains stronger in traditional financial services providers and products than in newer parts of the financial services ecosystem. However, there are signs that the trust gap is closing. The traditional retail banking providers, who have had time to build consumer trust over many decades, now need to innovate and adapt at speed to keep pace with the new entrants to the financial services ecosystem if they are to protect their existing market share. On the other hand, for new market entrants, the primary challenge is to build trust with consumers and swiftly expand market share before the traditional providers can pivot to counter their first mover advantage. Finally, sustainability. The COVID-19 pandemic has heightened consumer awareness of and desire for sustainable lifestyle options. Indeed, the crisis has accelerated existing sustainability adoption trends in the FMCG, fashion, and automotive sectors, and this is projected to continue growing. While consumer adoption trends for sustainable finance products had so far lagged compared to other sectors, this is rapidly changing. Alongside consumer demand for more sustainable finance options, there is also increasing pressure being exerted on financial companies due to government policies and regulations, as well as commitments made by part of the industry itself at COP26. Let's explore each of these trends in more detail and take a look at how the global financial services landscape is changing and is anticipated to change in the future. Firstly, let's take a look at the changing face of retail banking with a comparison between usage of traditional retail banks, i.e. those who have a physical branch presence, with digital-only banks, i.e. those accessed solely online or by app. At the global level, we can see that use of traditional bank accounts outpaces usage of digital-only bank accounts, with around 2/5 of consumers having received a payment into or made a transaction from a traditional bank account in the last 3 months, compared to just 1/4 of consumers who have done the same via digital-only bank account. This trend is broadly consistent across Great Britain and mainland Europe and the Americas. However, we do see that there is a distinct narrowing of the gap between traditional and digital in MENA, India, and APAC, with 39% having used a traditional bank account versus 30% having used a digital-only bank account. Let's now dive into how this differs by market within the MENA, India, and APAC region. Here we can see that there is notable variation by market. Australia and Hong Kong have the widest adoption gaps between traditional and digital bank accounts and continue to have strong reliance on traditional bank accounts. In contrast, we can see that the adoption gap between traditional and digital is narrowest in the UAE, India, China, and Indonesia, with the usage of digital bank accounts in Indonesia in particular outstripping usage of traditional bank accounts. It is, however, important to note that the Indonesian and Indian data is taken from a representative sample of online consumers in these markets, and therefore may not be fully representative of the whole population, such as rural consumers. When we look into adoption rates by age, perhaps unsurprisingly, the gap between traditional and digital banking is widest amongst older consumers. At a global level, around 1/3 of those aged 18 to 24 years old have used a traditional bank account to make or receive payments in the last 3 months, compared to almost half of those aged 55 years or older. In contrast, 1/4 of younger consumers have used a digital-only bank, whereas this is just 1/5 amongst the over 55s. Let's now take a look at trust between these two retail banking choices. In green, we see the net of those who strongly or somewhat trust each type of bank. In grey, those who neither trust nor distrust, and in red, the net of those who strongly or somewhat distrust each type of bank. Unsurprisingly, given their legacy across markets, trust is significantly higher amongst traditional banks than it is in digital banks. However, again, we see some interesting regional variations here, with consumers in MENA, India, and APAC demonstrating the highest levels of trust and lowest levels of distrust in digital-only banks. By comparison, consumers in Great Britain and mainland Europe and the Americas have much more polarized levels of trust in digital-only banks. In order to overcome this trust barrier, digital-only retail banks need to focus on providing reassurance as to the safety and security of funds held with them, and reassurance that there is an ability to speak to someone if something goes wrong. However, that said, neither of these aspects will be able to reassure all concerns. For instance, the concern over the lack of ability to access funds in the event of not having access to the internet. Let's now turn our attention to the changing payments landscape, where we compare the use of cash to new and emerging payment technologies and options. Here we look at cash payments in red, contactless card payments in purple, contactless mobile or device payments in blue, and online payments using a digital wallet in green. Globally, we see that cash remains king, though closely followed by contactless credit or debit card payments, and then digital wallets for online payments. Contactless mobile or device payments have much lower rates of adoption, but again, we see quite notable variations between regions. Great Britain and mainland Europe and the Americas broadly follow global trends, albeit with higher rates of cash usage and adoption of contactless card payments in Europe than we see globally. However, again, MENA, India and APAC lead the way in terms of adoption of new payment methods, with almost 2/5 of consumers using contactless mobile or device payments and almost half using digital wallets. Let's drill into the market specifics. Usage of cash remains strong across all markets in MENA, India and APAC, but we do see accelerated rates of usage of other emerging payment methods across these markets. Hong Kong leads in terms of adoption of all potential payment methods, with significantly higher usage of contactless mobile payments and digital wallets than seen for any other international market. With buy now, pay later also emerging as a challenger to the traditional payments landscape, let's take a look at how adoption levels vary globally. Overall, adoption of buy now, pay later is limited globally compared to the other methods we've just explored, with the strongest rates of adoption in MENA, India and APAC. Let's take a look at this in more detail. Within this region, consumers in Indonesia have the highest rate of usage of buy now, pay later in the last 3 months, followed by India, Australia and China. Hong Kong has the lowest rate of usage overall and behind the global average. Taking a look at the profile of consumers globally, we can see that usage is typically skewed towards those aged 25 to 44, with the lowest usage amongst those aged over 55. Let's now take a detailed look at the profile of buy now, pay later consumers at a market level. Here we've used the example of Australian consumers who use buy now, pay later. Over 1/5 of consumers in this market have used a buy now, pay later plan in the last 3 months. Compared to the nation, they are less likely to consider themselves as financially secure and are more likely to say that financial matters confuse them. They have a tendency towards making impulsive purchases, agree that having some level of personal debt is normal, and are worried that they'll never be able to save up to indulge themselves. Although this may indicate that buy now, pay later consumers in Australia find it more challenging to manage their finances, actually a higher proportion of them fall within the higher income level than the nation. Now let's take a look at trust in different emerging payment methods, specifically digital wallets and buy now, pay later. Overall, we can see that there are stronger levels of trust in digital payment wallets across all regions, most notably in MENA, India and APAC. In contrast, there are notably more polarized perceptions of buy now, pay later companies, particularly in Europe, where we see an equal number of consumers trusting and distrusting buy now, pay later companies. This may present an opportunity for more traditional financial services brands, such as retail banks, to capitalize on their existing trust levels and introduce an equivalent product to the market. Finally, let's take a look at the changing investments landscape. Here we show the proportion of consumers who, in the last 3 months, have traded stocks or shares or other investments using an online investment platform or app in red, owned, bought or paid with cryptocurrency in purple, and made a sustainable investment in blue. Overall, we can see that usage in the last 3 months has been relatively low, with online trading platforms the most commonly used in the last 3 months. Across all 3 types of investment activity, we can see that MENA, India and APAC lead adoption compared to other regions. Let's take a look at how this varies by market. Across MENA, India and APAC, we can see quite a variable picture when it comes to usage of the different investment types in the last 3 months. Online trading platforms see the strongest usage, particularly in Hong Kong, Singapore and India. Cryptocurrency adoption is also higher than we see in other international markets, with Indonesia and India demonstrating the highest levels of usage compared to any other international market in our study. Indonesia and India also lead recent adoption of sustainable investments, with just under 1/5 of consumers having made a sustainable investment in the last 3 months. Again, let's take a look at trust in different emerging investments, this time focusing on sustainable investments and cryptocurrency, although noting that this data is from before the crypto crash in May this year. Overall, we see higher levels of trust in sustainable investment, most notably in MENA, India and APAC. In contrast, we see extremely high levels of distrust in cryptocurrencies, most notably in Great Britain and mainland Europe. So how is this landscape projected to change in the future? We asked consumers globally to tell us which financial products they were likely to take out or use in the next 12 months. The red bar highlights the activities that consumers have done in the last 3 months, effectively the baseline we've just been exploring. And the purple bar highlights the activities that consumers intend to do in the next 12 months. Globally, the usage of cash looks set to fall the furthest, with a projected decline of 3%. In contrast, we see that sustainable investments are set to grow the most, with a projected increase of 4% in the next 12 months. With sustainable investments set to see the strongest growth, let's take a deeper look at the issue of sustainability in financial services in more detail. The COVID-19 pandemic has heightened consumer awareness of and desire for sustainable lifestyle options, with this further driven by the occurrence of increasingly extreme weather events that have been linked to climate change and climate-linked natural disasters. This confluence of events has accelerated existing sustainability adoption trends, particularly in faster-moving sectors such as FMCG, fashion, but also increasingly in the automotive sector as EV consideration starts to increase. We've seen a proliferation in product innovation and category growth for plant-based meat alternatives, as well as an increase in the number of consumers who describe themselves as flexitarian, i.e. incorporating more plant-based meals into their diets, or climatarian, i.e. those who actively make diet considerations based on the contribution of what they eat to the carbon footprint. We've also seen growth in sectors that increasingly focus on ethical supply chains, closed-loop clothing manufacture, and the reduction in the usage of plastic in packaging. However, brands have faced real challenges in this space, with accusations of greenwashing levied at corporations that purport to offer sustainable alternatives, but without fully embracing and adopting this into their business DNA. As such, there is an increasing need for brands to authentically deliver on ethics and sustainability and to evolve over time if they are to remain relevant to changing consumer demand and expectations. Consumer adoption trends for sustainable choices in financial services have so far lagged compared to other faster-moving sectors. However, this shouldn't be surprising. From the consumer perspective, it is easier for them to identify ways that they can reduce their carbon footprint and increase the sustainability of their lifestyle by making different choices about what they consume on a daily basis, particularly when the rate of innovation and new product launches in this space serves to build further awareness as well as meeting already rising consumer-led demand. Rarely is it the case that the first area of their life that they decide to explore and change is their finances, largely because it doesn't initially permeate consumer consciousness that the financial industry has a leading role to play in helping economies decarbonize, and that their financial choices could be adjusted to be more sustainable. The reality is that awareness in this sector typically tends to come once consumers start considering how to make more ethical or sustainable life choices in general. And this process of self-education subsequently builds awareness of viable choices in other sectors, including financial services, where both awareness and expectations have already started to follow the accelerating trends seen in other industry sectors, and consumers are increasingly seeking more product innovation in this space. With these shifting trends in mind, YouGov has recently launched its Sustainable Finance Index, which tracks perceptions of financial brands against metrics such as ethics and values, commitment to environmental sustainability, social sustainability, and diversity and inclusion. We also assess expectations of the actions financial companies should take to become more sustainable, as well as understanding the actions consumers are taking to increase the sustainability of their finances. The Sustainable Finance Index is currently live in the UK and the US and available to launch in other markets also, and we'll be using some of the data from the Sustainable Finance Index during today's presentation. When we look at why consumers, or what consumers consider when choosing a financial services provider, globally, a quarter of consumers do consider ethical values and a company's stance on environmental sustainability when making their choice. This ranks behind basic hygiene factors such as the safety and security of money, low or no fees, and good customer service. As such, a commitment to sustainability can help financial companies to stand out in the decision-making process, particularly if they're already competing strongly on the hygiene factors we've just discussed. When we split this by age, it is evident that environmental considerations are of much greater concern and importance to younger consumers aged 18 to 34, with environmental factors being considered by a third of global consumers in this age group, compared to just a fifth of the over 55s. Given this audience are likely to form the wealth-generating consumers of the future and have increasing earning and spending capacities, this is an important audience for financial services companies to tap into now. And this is not just limited to financial services. Indeed, we can see that consumers aged 18 to 34 are significantly more willing to pay more for sustainable products, the lighter green bar, and to try to align themselves with companies that are socially and environmentally responsible, the darker green bar. Globally, it's widely acknowledged that the financial industry has a key role to play alongside regulation and government policies in enabling the world to transition to a net zero and sustainable economy. However, to what extent do consumers recognise the importance of the role financial companies can play in supporting this transition? Globally, over 2/5 of consumers recognise the role financial companies play in driving global sustainability. However, the degree to which consumers are aware of the role financial companies can play varies enormously by region, with consumers in MENA, India, and APAC the most likely to think financial companies have a significant role to play, and consumers in Great Britain and mainland Europe the least likely. Again, we see significant variation by market within each of these regions, so let's dive into this region in more detail. Across MENA, India, and APAC, we see almost 3/5 of consumers believe that financial companies have a leading role to play in driving global sustainability, with this sentiment strongest in India and Indonesia. Consumers in Hong Kong are the least likely to agree, though this remains on a par with the global average and significantly ahead of other international markets, such as Germany, where only 23% of consumers believe that financial companies have a leading role to play. Let's now move away from perceived corporate responsibility and look instead to personal choices to understand the current levels of adoption of sustainable finance options, as well as projected future adoption rates. To do this, we will leverage the Rogers adoption curve and plot the rate of adoption of sustainable investments against this. Before we get into the detail as to where sustainable investments sit on this curve, let me first explain the curve to any of you who may be less familiar with it or with the adoption groups defined on it. For any innovation in market, we see common trends of adoption apply. If we take the x-axis of the chart shown, total market share moves from 0% on the left-hand side to 100% on the right-hand side. Each of the groups that we have identified forms a proportion of that market share, starting with the innovators on the left-hand side, which form about 2.5% of the total market, through to the laggards on the right-hand side, which form about 16% of the total market. Let's briefly run through the different groups you see here. Firstly, the innovators. This group tends to be the first to adopt a product in the market. Typically, they tend to be willing to take risks, are the youngest in age, and have strong financial lucidity. They also tend to be highly politically and socially engaged and like to adopt new products that align to their personal philosophies and values. Early adopters are the second fastest category of adopters. Like the innovators, they tend to be prosperous risk takers, but prefer to take informed risks as their level of financial lucidity tends to be lower than that of the innovators. They also tend to be more connected with their peers and therefore tend to act as influencers that introduce new products or innovations to a more mainstream audience. They like to be proponents of change, though they are more discreet in their adoption choices than the innovators. The early majority tend to be more conventional, and although they're open to new ideas, they tend to be more risk adverse than the early adopters. As such, their adoption time tends to be significantly longer than that of the innovators and early adopters. This group is not afraid of change and innovation, but they don't tend to seek it out. Rather, they tend to adopt innovations once it reaches a stage that it aligns with their needs and has been proven to have positive benefits with limited risk of failure. The late majority tend to adopt an innovation or new product after the average member of society. They tend to approach new or non-traditional ideas or innovations with a degree of skepticism, and after the majority of society have adopted. They tend to be older, less willing to change, and more tied to what they know works for them or what is aligned to their worldview. By comparison, laggards are the last to adopt any innovation and tend to be the oldest, most traditionalist part of a population. You'll also note that on the adoption curve we have shown here that there is a gap between the different segments. This is called a credibility gap that exists from groups moving left to right and needs to be bridged in order to convince the next portion of the market that a product or innovation is right for people like them. This gap is widest between the early adopters, i.e. the risk takers, and the early majority, i.e. the more risk adverse. And this is where many new innovations can fail. The goal for new product innovations is to cross this chasm between these two groups and move from the early market into the mainstream market with a view of achieving accelerated growth and market penetration. So where do sustainable investments sit on this adoption curve? Are they more esoteric and risky investments, or increasingly accepted as an alternative investment option? And where are they likely to be in the next 12 months? Let's take a look at the current baseline. From our data, we can see that 16% of global consumers have already taken out a sustainable investment product, be that impact investing or eco-investing, or have adjusted their existing investments to be more sustainable, for example, restricting their investments to specific industries or sectors, or excluding specific companies from their investment portfolios. As you'll recall, we also asked global consumers about their intentions in the next 12 months, and 12% intend to take out a sustainable investment product during that timeframe. Now I say that, but I do want to add a clear caveat. We know that there's a sizable say-do gap between what consumers say they will do from a sustainability perspective and what they ultimately do in reality. From a financial perspective, this comes down to a range of different factors, but is also primarily driven by the rates, fees, and projected returns they're likely to earn by changing how and where their investments are made. For example, despite 40% of US consumers stating that ethics and values are more important to them than returns on their investments, the concept of financial sacrifice actually tends to significantly impact adoption rates, simply because it makes consumers feel as though they are losing by making sustainable choices. Indeed, we know that there remains a strong lingering perception that sustainable investments come with both higher fees and weaker returns than more traditional investments, even though the reality of that situation is changing. From the Sustainable Finance Index, we know that, for example, around a third of US consumers think that this is the case. And this perception tends to create the view that choosing sustainable finance options comes with a direct financial sacrifice. This is likely to inhibit future rates of adoption in the short term, until evidence proves the contrary to be true in the longer term. With that in mind, it's likely that we won't see a full conversion of that 12% within the next 12 months. Furthermore, despite intent, a number of these consumers won't take any action at all, regardless of the comparative returns and fees on sustainable investments for other reasons. Let's instead hypothesize that only half of those who intend to take action actually do so circa 6%. Where would this put us on the adoption curve for sustainable investments? So our current baseline of 16% adoption puts us right on the edge of the chasm, albeit still in the early adopter space. However, even with our either pessimistic or realistic projection of 6% for the next 12 months, depending on your viewpoint, this already takes us across the adoption chasm and shows sustainable finance entering the mainstream market. From this point, we're likely to see substantial acceleration and take-up of sustainable investments and therefore category growth. So where is this growth currently coming from? Let's look at some example profiles of who is driving demand for sustainable investments, starting with age. Here we show 3 specific types of actions consumers may have taken to increase the sustainability of their finances, which include taking out a green investment product, asking that their money is not invested in specific sectors, or taking out an impact investment product. From our data, again, we can see that it is younger consumers who are driving demand for more sustainable finance. In particular, just under a quarter of consumers aged 18 to 34 have taken out a green investment product or an impact investment product. From a profiling standpoint, we see that the younger consumers tend to be more aligned to the profile of the early adopters and initial stages of the early majority, with these typically younger than the remainder of the population, a higher risk tolerance, and also a higher financial liquidity and indeed longer time horizons that enable them to better tolerate losses. This is in contrast to older respondents, where only 7% of consumers aged 55 plus have taken out a green product or an impact investment. From a profiling perspective, we tend to see that this age group are better aligned with the profile of late tail early majority and the early part of the late majority. This group are likely to have comparatively shorter time horizons given their age and are likely to be more sceptical about adjusting their investments than the younger age groups. With this in mind, they're likely to be comparatively slower adopters of sustainable finance, particularly if they view these products as potentially requiring a financial sacrifice in order to adopt. From their perspective, they're only likely to adopt these products at scale once the perceived risk of these investments is minimized, and if returns and costs are on a par or better than their existing investment options in their time horizon. Let's now take a look at a detailed market profile of sustainable finance investors. Here we have selected Indonesia, as it is one of the markets leading in adoption of sustainable finance products in the MENA, India and APAC region. Aligned to global trends, Indonesian sustainable investors are younger than the nation, often male and more likely to be single. They tend to have mid-level incomes, but focus their investments on taking high risks to achieve high capital growth. They are more likely to have recently started a new job and purchased a car for their own use. From a wider sustainability perspective, they don't mind paying more for sustainable energy, prefer brands that are sustainable, and only buy clothes from sustainable clothing brands. When it comes to their attitude towards risk, they don't mind taking risks with their own money and like to take risks in the stock market. And that brings us to the end of today's presentation. To summarize the trends we have shared with you today, the rate of transformation and fragmentation of the financial services industry is unlikely to slow anytime soon. Instead, it's only likely to further accelerate as traditional industry players rush to evolve their business models and product portfolios to defend their share of consumer wallets from the proliferation of new market entrants and product innovations, and as consumer trust in new and emerging product categories grows. We've already seen that trust is key to driving adoption. For traditional financial services companies, this means building on their trusted legacy to generate growth for the future ahead of new and emerging players. For new and emerging players, on the other hand, it means working to build trust in innovation before traditional companies can gain traction in new product spaces. And finally, sustainable finance is projected to see the strongest growth in the next 12 months and to move from early adoption to early majority within the next year. With financial companies striving to reduce their emissions, including those on their balance sheets, it's likely that a combination between rising demand and rising supply of products in this space will converge to accelerate growth in this area even further in the near to mid-term. That's all we have for you today. Thank you all very much for your time and attention. We'll now open up the floor to any questions that you may have.
Thank you, Emma, for a very insightful presentation. As Emma mentioned, it's now time for our audience Q&A. I'd like to reintroduce Irvin Ha, YouGov's Head of Commercial for APAC, who will also be on hand to answer any of your questions. So thanks to those that have already submitted theirs. Please remember, if you do have a question, it's not too late to submit them via the chat function. But yes, let's get into it. So our first question is from Anisha, who has asked, do you think that the trends you've been talking about will change with the news that the cost of living is under the highest inflation that we've seen in years?
I think we are likely to see some changes in consumer behaviour. I think particularly when we think about the use of discretionary income, which may have been directed towards investments. I think also the use of possibly debt vehicles like buy now, pay later may be stymied. Equally, for those who are more at risk and potentially on lower incomes, the converse might be true. We may actually see an acceleration in buy now, pay later as a consequence because people are unable to afford what they want in the short to mid-term. I think overall the trends are likely to remain very similar. I don't think we'll see any slowing of innovation in financial services just because cost of living is rising. If anything, we're likely to see that accelerate. So I hope that answers the question. Irvin, is there anything you'd like to add to that from your APAC view?
Agree. So I think one of the things that we talk a bit about during this call was about sustainability. And if we look at live example of, how important is sustainability in an overall sense, and then, we can look it back to financial services. Australia just had an election over the weekend. And when we look at election results, you see a huge swing towards the Green Party. Sustainability in Australia is getting bigger and bigger. It's becoming a much, much bigger issue. I don't see this, being discounted anywhere else in Asia, where everybody is talking about it. Everybody, especially the young ones, are looking towards, what's going to happen in the future. And as all these young people, and myself included, I would love to say, is looking forward to all these innovations in the future, this is where financial services brands can also better understand consumers. What are they looking at? How are they thinking? And from there, create those products, those solutions, and those campaigns that target these consumers.
Thanks, Irvin. And that's quite a nice segue into our next question, which was, how do you see sustainability being managed by YouGov's data?
So, sustainability is a huge topic. Obviously, for the purpose of today's session, we focus very much in on sustainability in financial services. And I think there's a number of different lenses that are important within the financial services industry in particular. One is the degree to which brands are being seen to embrace sustainability, but not just embracing it, really building it into their DNA. I think we've seen a few examples from some of the global financial brands in particular, where they are increasingly starting to promote their sustainability credentials. But then actually, there is a lot of criticism that comes towards them about how they're holding different funds on their balance sheets, what lending and financing activities they're trying to do. And the other side is obviously what consumers are doing in terms of adoption in financial services. So that's where the Sustainable Finance Index comes in for a number of our clients, because obviously we're able to measure what's happening from a brand perspective, i.e. how well each of these brands are performing on key sustainability metrics, but also what are consumers doing? Is level of awareness rising? Is the amount of action consumers taking increasing? Alongside that, though, we do have a huge number of other measurement vehicles in YouGov that are constantly looking at how consumers' behaviour is changing over time. For example, a lot of the profiling tools that we have looking at, are people buying sustainable clothing brands? Are they changing how they're eating? Are they considering electric vehicles instead of traditional vehicles? Are they changing how they're travelling? When we look at some of the travelling profile work that we have, are they choosing low carbon destinations, reducing long haul flights, etc.? So there is a vast array of different measurement tools that we have that allow us to unpick the changing face of sustainability in financial services and broader than that. Irvin, is there anything you'd like to add to that?
No, that's perfect. Thank you.
Wonderful. Thank you.
And we've just had a couple of questions come in, a two-parter. I'll just go touch on the sustainability, given that we've just been speaking about that. But Dong has asked, regarding sustainability, what do you think would trigger older age groups to invest more into green products, and as they are the groups with more stable and maybe higher income sources?
I think for the older age groups, there is always a reticence to move to things that they are less familiar with, I think, particularly when we're thinking about their time horizons. The 55 plus age group in reality largely are investing for retirement, which for many of these people won't actually be that far away. I mean, if we look at European markets, it's going to be 65 plus, well, 70 plus, depending on when the age breaks change. But we're seeing a real reticence to shift investment portfolios that they know are currently performing really well into investment portfolios that they don't see have had a longer track history of proven returns. And with stock market volatility and various others, it can create a concern around, can I take the risk before I have to retire? What if I lose money on my portfolio that I wouldn't have lost if I had moved it? I think what we really need to see in order to convince the older consumers to switch is going to be more around over time performance of sustainable investment funds. I think also building awareness that sustainable investments don't necessarily come with higher rates, fees, and lower returns, but that's going to be the key to helping convince people to try to make the change, is either proving they are more stable than other funds, or they're at least as stable and perform on a par with no extra cost attached. Removing that potential sacrifice or additional risk element is going to be what's key for encouraging the older groups. The one thing I would say, though, is that although they may currently be those with more stable and potentially higher income, equally the 18 to 34-year-old group will become that group of the future. So I think seeing that transition at this stage is also important to make sure that we have a long-term funnel that focuses on the wealth generators of the future also.
Exactly, and I think, you know, if I bring something much more personal into this, I've actually spoken to my parents about this, and they are of the older group, you know, as you mentioned in this question, more stable, higher income, and they are looking at time horizons, right? And based on their time horizon, they have actually mentioned it doesn't make sense for them, you know, and the risk averseness of this group of people also is a factor to play. However, it doesn't mean that they don't care, right? And that's where they've actually come to me and go, you know what? Why don't you look at it, Irvin? And that's what I'm looking at, because they acknowledge that this is interesting, it is important, but at their life stage, it's not something for them. They see it for the younger group. And I think as we look at the younger groups, and we're talking here about, you know, 40s and below, still stable, say, yeah, we are looking at that. You know, we are looking towards sustainable investment. Is something which is interesting. As I speak to people and my clients, you know, a lot of people are looking towards it. What we need right now is really financial services brands to really start talking about it and creating much more interesting products and be able to communicate it out properly to the consumers.
And I think also help educate consumers. Right, so it's not even just the development of the product, it's also helping people realize that these products are available, being able to demonstrate the performance of them, and then, you know, just building that awareness level. And I think at the moment there is a lack of understanding to some extent, not a lack of desire, I would hasten to add, but to some extent a lack of understanding in the consumer base.
Thank you both. And the other part of the question was, could you just explain how the adoption curve was plotted and why we have those figures amongst the adoption curve?
Okay, so the adoption curve is a standard adoption curve that's used to map out innovation in general. The numbers along the bottom simply represent the approximate size of each of those different audiences. In fact, if I go back a couple of slides, we should be able to see on here. So you can see here that each of these represents a market size. So the 2.5, for example, that's the size of the innovator's audience. So when a product first enters a market, that's the size of the audience that are going to be an innovator group. The 13.5 is cumulative on top of that. So 13.5 is the size of the early adopter market size. So at that point, we're at 16%. So 2.5 innovators, 13.5 early adopters means 16% total market share. And that accumulates all the way over to 100% on the right-hand side. It just represents how generally market share movements in innovation tend to work. I hope that helps answer the question.
Thank you, Emma. Yes, no, definitely. And I think that brings us to time and wraps up all of our questions and eventually concludes today's webinar. So yes, as mentioned, everyone, the recording of today's webinar alongside the copy of the slide deck will be shared afterwards to the email address that you've registered with. A big thank you to our fantastic speakers, both Emma McInnes and Irvin Ha. Thank you for, and lastly, thank you to the audience for taking the time to join us today. On behalf of YouGov, goodbye and have a wonderful rest of your day.